Have you ever wondered how a company truly demonstrates its financial health? In a world filled with optimistic press releases and carefully crafted executive statements, investors are rightly skeptical of words alone. They seek tangible proof, a concrete action that separates genuine confidence from hollow bravado. One of the most powerful and enduring signals a company can send is the payment of a dividend. A dividend is a direct cash payment made from a company's earnings to its shareholders. It is not a projection or a promise of future success. It is a distribution of cold hard cash in the present. This simple act of returning capital to owners forms the basis of a powerful concept in finance known as dividend signaling. The core idea behind dividend signaling is rooted in a fundamental market challenge: information asymmetry. A company's managers have a deep, nuanced understanding of its operations, its competitive landscape, and its future prospects. They see the storm clouds gathering long before they appear on any financial statement. Investors rely on periodic reports, filings, and market data to piece together a picture of the firm's reality. Actions in this context speak far louder than words. Why is a dividend such a potent and believable signal? The answer lies in a concept called a costly signal. For a message to be credible, it must be hard or costly to fake. Anyone can claim to be wealthy, but only someone with real resources can make large, regular charitable donations. In the corporate world, a dividend works the same way. It uses up a company's most flexible, vital resource, cash. That cash can't pay down debt, fund new projects, or cover unexpected expenses. That cost gives dividends their signaling power. A weak company would find it painful or impossible to keep a big dividend. A healthy payer sends a message a weaker rival can't mimic. Picture a steady long-term dividend contrasted with volatile earnings in a cyclical peer. The signal is credible because it's costly. This directly addresses information asymmetry. Investors know managers have more information, but paying a dividend is verifiable. Cash leaves the company's bank and goes to shareholders. Parting with cash forces discipline on management. By committing to payouts, managers are tying their own hands and limiting discretion. It signals they expect strong, stable future cash flows, a public declaration of strength that investors often reward. How does a company signal that it is a bedrock of stability in a volatile market? One effective way is a long, uninterrupted history of dividend payments. A firm that distributes cash through booms and busts sends a message of durability and prudence. It shows profitability in good times and resilience when headwinds hit. Consider a French personal care giant with decades of reliable, often growing payouts, a testament to brand strength and predictable earnings. Even in recessions, demand persists enough to maintain commitments, attractive to income-oriented investors and risk-conscious portfolios. A diversified industrial leader smooths earnings across segments, reinforcing a steady dividend as tangible proof of portfolio robustness. Maintaining a dividend through crisis is the ultimate resilience signal. When entire sectors halt, suspending payouts can be necessary, clarifying the severity and conserving every euro. Imagine a firm that sustains its dividend amid turmoil. It declares fortress finances and exceptional confidence. High stakes, high credibility. Executed well, such signaling can cement a reputation for resilience that endures long after the storm passes. What happens when a company already paying a dividend decides to increase it? A dividend increase is a forward-looking statement. It says management expects earnings and cash flow to grow and commits to higher distributions. Markets pay close attention because the commitment is costly and durable. For a major European bank, a sizable raise can signal robust capital, improving loan quality, stronger margins, and a healthier backdrop. Investors may re-rate the stock as higher future profitability is priced in. In high-growth technology, a rising dividend signals a business so cash-generative it can fund innovation and still return excess capital. It matures the investment profile, attracting both growth and income investors, broadening the shareholder base. The increase makes success tangible today, not just promised tomorrow. A higher dividend is optimism made concrete. The market hears it, sees it, and often rewards it. Is the start of a dividend always a good sign? When a first dividend is initiated, it marks a transition in the corporate life cycle. Young firms often reinvest every dollar. Initiation signals maturity and surplus cash beyond prudent reinvestment. This can change the investment thesis. Some or growth holders rotate out. Income seekers and dividend mandates rotate in. The shareholder base can stabilize. A dividend cut is one of the most negative signals and is read as distress. It often means a cash crunch. Management must preserve capital to survive. During the pandemic, suspensions clarified the severity and removed hopes of a quick return to normal. A cut signals the ship is taking on water and management is battening down the hatches. Harsh as it is, the signal helps price reality, allowing rebuilding on firmer ground. Are dividends always the best way to return cash to shareholders? Share repurchases use cash to retire shares, lifting earnings per share and often the stock price. Regular dividends are perceived as promises. Cuts are disastrous. Buybacks are flexible and can be timed opportunistically. Firms can buy more when cheap and less when pricey without negative signaling. That flexibility helps firms with volatile cash flows. In many countries, including France and across the Eurozone, dividends are taxed when received, creating an immediate liability. Buybacks defer taxes until gains are realized, allowing pre-tax compounding, often preferred by higher bracket investors. Many mature firms keep a stable, maintainable dividend for signaling and income and use buybacks to return excess cash flexibly. Downright, investors get the discipline of dividends with the flexibility and tax efficiency of repurchases. Given all this, how should you incorporate dividend signals? Never rely on the dividend in isolation. A dividend is a signal, not the complete story. A high yield can be a value trap if the market expects a cut. Scrutinize earnings quality and free cash flow. Avoid payouts funded with debt. Key metric: dividend payout ratio, dividends per share divided by earnings per share. Above 80 to 90% is a warning. Focus on change and trend. Initiations and consistent raises are more compelling than a flat high level. When you see an increase, dig deeper. Is it one-off or core strength? Understand the why, not just the what. Consider taxes and opportunity cost. For high return firms, reinvestment may beat payouts. Heavy dividend taxes tilt toward buybacks. Dividends don't lie, but they don't tell the whole truth. They're credible, costly signals. One piece of the puzzle. Use dividend signals as a starting point. Combine them with fundamentals and buyback trade-offs, and you'll make more informed decisions. The payout is proof. True wisdom is knowing what that proof means.